what's a syndication? Syndication is one or two people sometimes, and they have a bunch of people, and this could be structured in one of two ways. Equity, which is maybe 95% of the deals out there, or debt, which is 5% or maybe less. So these investors give money to this person to buy a building. It's usually set up like general partner, and they are limited partners. So what does it mean, limited partner? They don't have voting rights. He or she wants to paint the building blue, building is blue. They're not here to make any decisions. They don't even have liability. You understand? There is no lawsuits that will come to them. That person will make all the decisions, and they're going to write a private placement memorandum. In it, they're going to say, we're going to solicit so many investors. It's going to be one deal, one asset. You understand? One asset is going to be this apartment building. Most syndications, there's $1 trillion in apartment building. Everybody likes apartment buildings. They're not exactly my favorite type of assets. They're very profitable, don't misunderstand me. I would do apartment buildings. I do apartment buildings, but they're not something I like too much. We have too many moving parts. You know, it's like, and then the guy couldn't pay the rent because he got laid off. This person's upset because the people upstairs are making noise, stuff like that. I do my commercial, nobody talks to me, I don't talk to anybody. It's more contracts, it's more transactional. Apartment building, sometimes more relationship. But anyway, so it's one asset, that's a syndication. Understand the difference now because I'm gonna break it down to you. One asset. Syndication is you raise money for one asset. Is that a problem? Not a problem at all. It's a very good way to do it. Can you pay them equity? That means you're gonna spell out for them. I'm gonna give you 4% cash flow only each year because we're gonna have to rehab the place. We're gonna have to kick out some tenants. We have to get new tenants. We have to fix the roof. We have to expand the place. You're telling them the plan. And from the upside, that means we bought the building for 5 million. We're gonna improve it for, let's say, 500,000. Then we intend to sell it in 5 years or so at 7.5 million. You're with me on this? So we're gonna put $1 million, we're gonna get a loan, we're gonna do all this work, I'm doing it all, I'm the syndicator, and you're investing in this. And I'll keep updating you periodically. We're gonna do the payouts, let's say once a year. We are not gonna do any payouts of interest or of any return from the cash flow for a whole year because that year we're gonna do so many things. On the second year, we're gonna do it semi-annually. So every 6 months. You see my point? So you structure it the way that's gonna make sense for you. And so you understand, you're gonna open an LLC. Listen to me carefully now, I'm gonna break it down to you. You're gonna open an LLC, which is gonna be here in the private placement memorandum. Let's say we're gonna call it 123 Fuller Street LLC, which is the name of the apartment building. And you're gonna tell people, I'm gonna raise $1 million. Well, you're gonna raise actually $2 million for the $5 million deal. 1.5 million will go as deposit for the loan. Are you with me? We're gonna get a loan for X, and we're gonna keep $500,000 for what's called capital reserve. Everybody with me? What's capital reserve? That extra money that we're gonna use to fix the building, to evict some people, fix the units, pay some commissions, get it all to perform. It's gonna take us a year. By the way, in general, all real estate looks good on paper. I have never seen somebody present to me a real estate deal that's horrible. Look, we're gonna lose our butt. Would you like to invest in this? So you have to see beyond the hope and the wonderful stuff, okay? So first question is this the right building? Is this the right location? Can they do this within that period of time? Can they do it for that cost? So a syndication is very interesting. And what's an upside? What's an upside? Upside is we bought it for 5 with all the fix up. We're gonna sell it at 7, let's say. So the upside is $2 million. Are you with me? Minus the commission when we sell, minus the rehab and all this, we have 1.5 million profit. So we're really putting a couple million up front. We're gonna have some cash flow, and at the end, we're gonna sell at 1.5 million profit. That's what we target. That's our anticipated return. So from that upside, let's say it's 1.5 million, we're gonna give the investors 70%. We're gonna give them $1 million. The other $500,000 will go to the syndicator. You being the syndicator. That's an equity syndication, which is most of syndications tell people, we're going to give you little cash flow, we're going to give you a big payout later. It's going to average maybe 12% annual rate of return. But they present it in a different way. They don't say annual rate of return. That means you take the money divided by how many years. They call it IRR, internal rate of return, which is very confusing, very hard to calculate. Even if you have the best calculator and everybody's sitting here, it will be different numbers for each one because you have different taxes, different this, different that. So it's very misleading and it's tricky. And provided they follow the rules to raise the capital and deploy it, they're going to be okay, and you will still come out okay as an investor. But this is syndication. Any question on syndications? You understand what it is? What's a debt syndication then? It could be, hey guys, you're just going to actually put so much, and I'm going to give you a return of, let's say 7.5%. You don't have to get 4 and then hope for an increase. I'm just going to pay you a flat fee, 7.5%. I'm going to take your money. I'm going to put some of my own money. We're going to use it as down payment. We're going to get the loan from the bank. So you're going to get 7.5%. I'll pay you semi-annually. And you have a lot of people that like that debt fund because now they like the steady return. They like it's cash flow more. And like my funds are set up as debt funds. I don't do equity funds. And I don't charge fees because when you charge equity fund, you have ways to charge people money. Yeah, well, usually the PPM will be either equity or debt. They don't do the hybrid. Although I do a hybrid one. Yeah, it's going to say most PPMs for private placement memorandums. Yes, and that's not good. I'll show you how I do mine. There is a summary. This is what people read. I do a video. You want the investors to be so clear because if you get investigated, which they don't call it investigation, like in the beginning they send you a letter say it's an audit. This is a friendly audit, we're not accusing you of anything. Send us all your bank accounts, send us all your transactions, send us all your communication with all your investors, send us all emails, text, pictures, videos, anything you've done. That's why I film. Because that stuff goes to the SEC if and when they do an audit friendly. And I had a friendly audit. It took 2 years. Very friendly. Yeah, it really, but it was the best thing that happened to me in my life because I got to really understand the insider, and that's when my game of setting up funds took another level because they said, send me the letter, and I'm telling you, and I'm filmed, and these films, are archived, and I have to be disclosed to the SEC anytime they want. They said, we found nothing to even give you a suggestion, continue as you have. That's when I had the confidence to say, okay, let's go scale this.